Hello friends and welcome back. Friends, in the previous video, we discussed how to calculate LTM financials of the company, and then we calculated LTM financials of company Coca-Cola on the basis of its reported numbers. In this video, we will discuss process of cleaning those reported numbers for any exceptional or non-recurring item what company has reported in its income statement. So let's see how we do that. As you can see under this key financials table, we already have reported financials of company Coca-Cola, which we have calculated in the previous video. Now, in this key financials table, we have reported sales. Friends, normally company does not report any exceptional items in sales. So this reported sales is considered as a clean sales of the company. Then we have reported EBIT or operating income of the company. In this reported EBIT or operating income, we will make adjustment for all exceptional items which are reported above EBIT, so that we can get clean or adjusted EBIT of the company. So here we will reverse impact of exceptional items which is impacting my reported EBIT. Then we will add depreciation amortization expense in adjusted EBIT to get adjusted EBITDA of the company. Once we got adjusted EBITDA of the company, we will move to net income. Now, as you can see, we have reported net income here. Then we have adjustments for the reported net income under row number 76, 77, 78 and 79. And then finally, we will arrive at adjusted net income. So let's see how we do that. In row number 76, we will clean or reverse impact of those exceptional items which are reported above EBIT. And as we have already discussed these exceptional items under row number 70, so under net income, we will directly link these adjustment items from row 70. Friends, as the net income comes later to the EBIT, so all the exceptional items which are affecting your EBIT will definitely affect your net income. So rather than repunching these numbers again for the net income, we are directly linking it from the EBIT adjustments. In the next row, we have exceptional items reported below EBIT. So in case company has reported any exceptional item below EBIT, we will make adjustment for those exceptional items separately in the net income, as these items will only impact your net income but not EBIT. Then we have less tax on adjustments. So here we will reverse tax impact of exceptional items what we have reported under row number 76 and 77, as net income is after tax. So whatever adjustment we make in the net income, it should also be net of tax. So friends, while reversing impact of exceptional items on the net income, we also reverse tax impact on the same. Then we have separate row for non-tax deductible adjustments. So here we will adjust those exceptional items which are impacting net income, but they are non-tax deductible. So basically they will be adjusted grossly as they are non-tax deductible. So adjustment would be no tax basis. Friends, purpose of taking these exceptional items separate from row number 76 and 77 is, under row number 76 and 77, we are going to consider those exceptional items on which we will reverse tax impact in the row number 78. So whatever adjustments you are considering under these two rows will automatically be adjusted for the tax impact. But in case there is any adjustment which is non-tax deductible, for example impairment of goodwill, we will not consider those exceptional items under row 76 and 77. Rather, we will consider them separately under row number 79, because we don't want to reverse tax impact on those exceptional items as they are non-tax deductible. Once we are done with adjustments of all exceptional items and tax impact on the same in the net income, I'll get my adjusted net income. in this adjusted net income, I'll subtract share of minority interest, because guys, this is what the total net income of the company, consolidated net income of the company, which is available for both common shareholders of the company as well as minority interest. So I will subtract share of minority interest from this net income to get adjusted net income available to common shareholders of the company. And then finally, I'll divide this adjusted net income with the diluted weighted average shares of the company to get clean diluted EPS. Now friends, let's see from where do we source these exceptional items for Coca-Cola. Source of information for cleaning financials of the company. Friends, we will find these exceptional items under annual report and quarterly reports of the company. Under financial reports, you have to go to section called management discussion and analysis. This is also called MD&A section of the company's financial report. Under MD&A section, you will find disclosure about the exceptional items, either as a separate disclosure about the exceptional items, what is impacting comparability of the financial statement of the company. So here, company lists down all the exceptional items which is impacting reported numbers of the company. Or sometime company gives you reconciliation between GAAP numbers and non-GAAP numbers. So here, GAAP number means reported numbers and non-GAAP numbers means adjusted number. So under this reconciliation, company will make a disclosure of all exceptional items which are impacting reported numbers of the company. Friends, in case we don't find any of the above disclosure in the financial reports of the company, then we can refer 8K related to earning results published by the company before detailed financial reports. So this is a press release issued by the company related to its earnings, and sometime company makes a disclosure of reconciliation of GAAP versus non-GAAP financials in this 8K. So if we find this disclosure about exceptional items in financial reports of the company, we can refer it from there. But in case we don't find this disclosure in the financial report, we can check 8K earning release of the company to find if the company has made this disclosure in the 8K reports. So friends, let's do adjustment for Coca-Cola. So let's start with adjustments in EBIT. For that, we have to go to financial reports of Coca-Cola. So here we go. Then we have 10K, 10Q of Coca-Cola. Let's first search 10K December 16. Here we go. So table of content. So friends, remember we have to go to MD&A section, and this MD&A section is on page number 29. So let's go to page number 29. This is page 27. Next and next. Yeah. So we reach to page number 29, and here we can see management discussion and analysis. Under this MD&A section, as you can see, there are 4 subsections: our business, critical accounting policies and estimates, operating reviews, and liquidity, capital resources, and financial positions. Friends, under our business part, company gives a general description about the business of the company and its operating segments. Under critical accounting policies, company discuss about the accounting policies it has adopted in preparing financial statements. Under operating review, company do and analysis of company's financial results. So this is important section for us to find exceptional items. In case company has reported exceptional items, it will be reported under this section. So we can directly jump to operations review section to find if the company has reported exceptional items under this. First is related to our business. We can skip this part and you can scroll down and critical accounting policies and estimates. So this is also not relevant section for us. Here we go. So as you can see, we got operations review section. So friends, in case company has made disclosure about the exceptional items, this disclosure you will find under this operations review section. Now, remember, this disclosure can be either in the form of list of exceptional items which is impacting your reported numbers, or it can be in the form of reconciliation between GAAP and non-GAAP number. So let's search what disclosure company has made under this section. So the first is about the structural changes, acquired brands and newly acquired licenses, not relevant for us. Then it is talking about beverage volume, not relevant. Then it is talking about unit case volume, not relevant for us. Concentrate sales volume, not relevant. Analysis of consolidated statement of income. So now he is discussing financial statement of the company and analysis of the same. So we might find exceptional items post this. So the first is discussing about net operating revenue in the financial statement. So as you can see in the financial statement, my first line item here is net operating revenue, then cost of goods sold, then gross profit, selling general and administrative expenses, other operating charges, and then operating income. So here company is discussing each line by line item of its income statement. So the first, they are discussing about operating revenue. So we can skip that part. Gross profit margins. So friends, here company is discussing about its gross profit margins and making comparison of 16 versus 15. Friends, in case we don't find disclosure about the exceptional items as a separate table or reconciliation of GAAP versus non-GAAP number, then we can read through these discussions and try to find those exceptional items what company has highlighted in this discussion as an items which is affecting numbers of the company. So then they are discussing about selling general and administrative expenses, next line item in the income statement. Other operating charges, operating income and operating margins, information about operating margins on consolidated basis, interest income, interest expense, equity income and loss, other income or losses, income taxes, a reconciliation of statutory tax and effective tax. So it's a reconciliation of tax rates of the company. And this section has been completed and the next section has been started, which is liquidity, capital, resources and financial positions. So friends, it means company is not making a separate disclosure about the exceptional items or reconciliation of GAAP versus non-GAAP numbers in its 10K. So in that case, we can refer 8K published by the company just before these detailed annual financials or annual report. So friends, here you can see we have 8K dated 9th Feb 17 and 8K dated 25th October 17. So this 8K dated 9th Feb 17 is related to the December 16 financial report. So let's open this 8K. This is earning release of the company related to its annual financials. So if you scroll down this 8K, you can see this is what the Coca-Cola company reports its fourth quarter and full year results. If you scroll down, and what we have to find in this 8K, yes, reconciliation between GAAP and non-GAAP numbers. So we can search it with keyword reconciliation, and you can see we got this reconciliation on page number 17 and PDF page number 21. The reconciliation of GAAP and non-GAAP financial measures. And under this, if you scroll down, yes, here we got reconciliation of GAAP and non-GAAP financials in tabular form. And the first, they are discussing the reconciliation for 3 months. Friends, we are looking for reconciliation for 12 months. So let's scroll down further. These are also for 3 months. Here we go. So here you can see company has made a reconciliation of GAAP and non-GAAP number for year ending 31st December 16. So this is what we were looking for. And under this reconciliation, you can see company has started with the reported numbers, which is GAAP numbers, and finally they have arrived at comparable number, which is non-GAAP numbers. Okay, so let's see guys what this reconciliation is and what items have impacted comparability of the company's financial results of December 16. Friends, in this reconciliation table, you can see first reconciliation is about net revenue, then cost of goods sold. So individual line items reconciliation is being done. And as we are making this adjustment directly in the operating income, so operating income reconciliation items, which is summation of all the reconciliation items falling before EBIT. So as you can see, under operating income, the reported operating income for December 16 is 8626. This is what company has reported in its income statement. And as per this reconciliation, adjusted or comparable operating income or EBIT is 9958. And company has made a disclosure of all the line items which has affected this operating income. So the item is assets impairment and restructuring, $393 million. So due to the impairment of some assets or restructuring activity of the company's EBIT is understated by $393 million. To reach an adjusted EBIT, we have to add back $393 million in operating income of the company. So we can make this adjustment in reported EBIT here. Add or less exceptional items reported above EBIT. So one of the exceptional item which is affecting my reported EBIT is $393 million, which is assets impairment and restructuring charges. Now friends, we can put this in comment what we have adjusted here in operating income. It's assets impairment and restructuring charges, $393 million. We can expand this comment box. Next, productivity and reinvestment, $352 million. Due to productivity and reinvestment activity, company's operating income is understated by $352 million. And to reach at the normal profit, company has added back $352 million reinvestment and productivity activity expense. Friends, to understand this line item, let's see what explanation company has given about this line item. Productivity and reinvestment. So friends, here we have explanation about this productivity and reinvestment activity of the company. So what it says, during the 3 months and year ending December 16, the company recorded a charges of $165 million and $352 million respectively related to our productivity and reinvestment initiatives. So friends, in the 3 months, company recorded a $165 million of expenses, and in the whole year, company recorded $352 million of expenses related to productivity and reinvestment activity. The company also recorded a charges of $368 million and $691 million during the 3 months and the year ending 31st December 15. So here the company is doing comparative discussion about the last year charges on the same activity. These productivity and reinvestment initiatives are focused on 4 key areas, and what these key areas are: restructuring the company's global supply chain, which is exceptional item. So company is restructuring its global supply chain, implementing zero-based work and evolution of zero-based budget principle across the organization. So company is doing some sort of streamlining here, standardizing some work processes here, which is one-time activity and should be adjusted. Streamlining and simplifying company's operating models. Again guys, this is one-time activity. Company streamlining its operating models, maybe to improve its efficiency and further driving increased discipline and efficiency in the direct marketing investments. So this is sort of restructuring of marketing activity of the company. So friends, as we can see, under this productivity and reinvestment program, company is incurring expenses mostly on the restructuring and efficiency improvement activities, and all these activities are one-time activities. So this $352 million what charges company has incurred last year should be treated as exceptional charges, and as company has also adjusted them under reconciliation statement of GAAP versus non-GAAP number. So let's add them in our reported EBIT, and we can make a disclosure under comment section that what adjustment we are making. So add productivity and reinvestment, $352 million. Let's move back to reconciliation. Here we go on page number 29. And also friends, in this comment box you can give information about the source of exceptional items. So we can mention here 8K dated 9th Feb 17, page number 29. Then next, some equity investees, which is 0. Transaction gains and losses, $456 million. So friends, as company is adding it back, it's in a reported income, so it means they are losses. What these transaction gains and losses? So we can check the explanation of these transaction gains and losses. Okay, so it's on page number 24, and as you can see, explanation of this transaction gains and losses, and it includes lots of line items. As you can see, this is the detailed disclosure about all the transaction gains and losses. So broadly, you can see what it includes. So during the 3 months and the year ending 31st December 16, the company recorded a charges of $127 million and $297 million respectively related to the cost incurred to refranchising of certain of our bottling operation. So friends, as the company has done some sort of refranchising of its bottling operation last year, and related to this, the company has incurred some charges. These are one-time charges, as the company will not do this refranchising activity every year. So likewise, company has given disclosure of all the line items which are falling under transaction gains and losses in December 16. So you can go through all of them, but prima facie it looks like all of them are exceptional items. So we can take the sum of all these exceptional items under reconciliation table. I'm taking this $456 million as an adjustment in my reported EBIT, and under comment box I'll mention here at transaction losses $456 million. Next, other items. So there are some other items, $131 million, by which my reported EBIT is understated. $131. Friends, under this other item, company might have included all other exceptional items, small exceptional items, for which separate disclosure might not be required. Other items, $131 million, and we are done. So you can see my adjusted EBIT here is 9958, which is same as what company has under this reconciliation of GAAP versus non-GAAP numbers. As we are done with the adjustments on EBIT, and my EBITDA is also adjusted now. Now we'll move to net income. So as we have reported net income 6550 for whole year. Now under net income, as we discussed, we have exceptional items reported above EBIT, exceptional items reported below EBIT. Exceptional items reported above EBIT are directly linked from H70. So as we have already adjusted these exceptional items in EBIT, so they will directly flow to net income also. Now next is exceptional items reported below EBIT. Here we need to make adjustment for all those exceptional items which are impacting my net income only, but not my EBIT. So they are the item which is reported below EBIT. So friends, as you can see in this reconciliation table, we have operating income reconciliation, and then if you scroll down, here you go, you can see here reconciliation of GAAP versus non-GAAP number for all the line items which are reported below EBIT and above net income. So you can see here interest expense equity income or losses. So this equity income or losses is basically share of company's JVs and associates earnings. As JVs and associates are not consolidated in the company's operation, so any proportionate shares of the earnings of the company in JVs and associates is reported as a separate line item below EBIT. For example, if the company has 25% stake in the other company, in that case, this 25% stake does not qualify to be as a subsidiary of the company, but company has significant influence on operation of the company as it is having 25% stake. In that case, my proportionate earnings of the company in which I have 25% stake would be added as a equity income or losses shares in my net income. So here you can see this equity income or loss net 835 reported is basically share of Coca-Cola's earnings in JVs and associate where it has significant control. Other income or losses. So there we company has all other line items of income or losses. Income before income tax. So this is PBT, profit before tax. Then income taxes. So we'll subtract income tax from PBT to get the net income of the company, and from this net income we will subtract minority share to get the net income available to common shareholders. Now let's do adjustment in the net income related to the items falling below EBIT. The first one is interest expense. So you can see interest expense reported is 733 and comparable interest expense is also 733. It means there is no adjustment in between reported and comparable or adjusted interest expense. Then friends, we have equity income and losses reported 835 and comparable is 896. Here we have an adjustment of $61 million which is affecting my equity income and losses. It means equity income, what company has reported last year in its income statement, is understated by $61 million of one-time exceptional loss or expenses. And accordingly, my net income is also understated in the income statement as net income is after this equity income. So we should add back this $61 million as exceptional item below EBIT. And in the comment box, I'll mention exception included in equity investee income or losses, $61 million. Next, other income and expenses, losses. Reported other income or losses is 1235, and whereas the adjusted one is 46 only, gain basically. So there are other losses of 1234, whereas the normalized gain is 46. So it means due to exceptional items of 1167 related to transaction gains and losses and other items of 113, my other income is understated and accordingly my net income is understated. So let me add them back. 1167 plus 113, 1341. Income before tax. So basically guys, this income before tax is PBT and all the adjustments you have done before. It's a summary of all the adjustments which is affecting your PBT. Next, we have income tax of 1586 what company has reported and the normal tax is 12432. It means due to the impact of all the exceptional items, these exceptional items, company's tax expense has also been affected. What company supposed to pay on the normal income is tax of 2432, whereas what company has actually charged is 1586. So friends, let's reverse the tax impact on exceptional items directly here, which would be equal to, and put the minus sign here before this bracket, because tax impact would be reversed to the adjustments. 2432 is my normal tax minus what tax company has already charged, 1586. So that differential part of the tax company has to pay to make this income normal, or in other words, if we reverse the impact of exceptional items, so this much additional tax company has to pay on its profit before tax, PBT. Add or less non-tax deductible adjustments. Friends, here we make adjustment for those exceptional items which is non-tax deductible, but in this case we don't have any exceptional items which is non-tax deductible, so we'll make it 0, and we got adjusted net income 8377, whereas the reported net income of Coca-Cola was 6550, but its normalized earning or net income is 8377. From this 8377, we will subtract share of minority interest in this normal income. So let's see what the share of minority interest here. So net income or loss attributable to non-controlling interest is $23 million on adjusted earnings. So we'll subtract this $23 million and we'll finally get 8354 as adjusted net income of Coca-Cola available to common shareholder. And we can see, guys, this net income should match with my comparable non-GAAP net income to Coca-Cola's common shareholders. And my clean EPS is $1.91. So friends, as you can see, we have made adjustment in our reported numbers on the basis of reconciliation of GAAP versus non-GAAP numbers, which is reported under 8K dated 9th of Feb 2017. Now, likewise, let's do adjustment in the current stub and prior stub numbers. So friends, for that, I'll refer 8K October 17. So friends, this is my 8K dated 25th October 17. This 8K is related to Q3 financials of the company. So let's go to the reconciliation part in this 8K. Here we go on page number 19, and if you scroll down, you can go to the reconciliation table. This is on page number 25th. But friends, we cannot consider this reconciliation table as this is only for 3 months, whereas my current stub is for cumulative 9 months, right? So this is only for Q3. This is only for Q3, not cumulative one. So you can scroll down. Here we go. So these are the numbers for 9 months. This reconciliation is related to Q1, Q2 plus Q3, which is 9 months, which cover my entire current stub and prior stub also. So friends, you can see here reconciliation items are more or less same what we saw in the annual filing. Assets impairment and restructuring, $737 million. Productivity and reinvestments, $355 million. Equity investment nil. Transaction gains and losses, $323 million. Other items, $115 million. So let's adjust them to reach at normalized earnings, and all these items are being added. It means they were all charges or losses. So let's reverse them in our reported EBIT. First one is 737 plus 355 plus 323 plus 115, and you can put explanation of all these adjustments in the comment box. Assets impairment, it's $737 million. Add productivity and reinvestments, it's $355 million. Next, transaction gains and losses. So basically it's losses because we are adding them back. It's $323 million. Other items, $115 million, and that's it. So my total adjusted EBIT is 7710 million. Now friends, in the prior 9 months, prior stuff, my adjustments are related to assets impairment and restructuring. It's $240 million, which will be added. Productivity and reinvestment 187, equity investee 0, transaction gains and losses 207, and other items $74 million. So let's adjust them. 240 plus 187 plus 207 plus 74. I'm sorry, we need to put equal to sign here. Okay, so my adjusted EBIT is 7979, and you can put explanation here in the comment box, the same what we did for current stuff. Now friends, let's move to next part. It's exceptional items below EBIT. So you can see here in the net income, we will first link our exceptional items which are flowing directly from the above EBIT part. Next would be exceptional items below EBIT. So we can scroll down. Here we go. So in 9 months, September 17, which is current stuff, exceptional items which is affecting my interest expense, which is the reported one is 631, whereas the normal one is 593. It means my interest expense is overstated by $38 million of exceptional items. And because of this overstating of interest expense, so ideally it should have been 593, my net income is understated by $38 million. So we should add this back, $38 million as an exceptional item below EBIT. And then next, under equity income, my reported equity income is 883, whereas the normalized report equity income is 920. It means $37 million of exceptional losses have understated my equity income from 883 to 920. And due to this understatement of equity income by $37 million, my net income is also understated by $37 million. So let me add it back. Then friends, in other income, I had a reported loss of 1122. This is what the company has reported. But normalized other income or losses is income of $154 million. So due to this exceptional losses, what a company has booked under other income or losses, my other income has turned negative from the normal 154. So my exceptional items should be adjusted here. 50, which is related to assets impairment charges. 1228 related to transaction gains and losses. And -2 related to other items. It should be -2. Means these -2 could be some exceptional gain. Then friends, we have income before tax, which is PBT. So all the line items before PBT we have adjusted. Then income tax impact. So tax what company has charged in the income statement is 1805, where the normal tax what company should pay is 2085. So tax impact on exceptional item is put minus sign there, bracket start. Normal tax is 2085 minus what company has actually reported 1805. So reversal of tax would be 280. Net income to the non-controlling interest is 0. So there is no net income to the non-controlling interest. Also, there is no non-tax deductible adjustments in 9 months 17. Now friends, in the previous 9 months, we have exceptional items. There is nothing exceptional in the interest expense, so it's 485, 485. Under equity income and losses, reported one is 678, but the normalized one is 713. It means there is an exceptional loss of $35 million, which is understated my equity income or losses and accordingly my net income. So I'll add back $35 million here. Likewise, other income and losses, exceptional item is 354 and 40. I'll add back 354 plus 40. Then guys, we have PBT and income tax. What company has reported 1618 and the normalized tax is 1971. So it should be minus 1618 minus, sorry, the normalized one is 1971 minus what company has actually reported 1618. So this differential tax company has to pay additional on its normal income 353. There is no non-tax deductible adjustment in 9 months and the share of minority in the normal income is 26. So from this adjusted net income, $26 million belongs to minority and my adjusted net income is 6761. So friends, as you can see, we are done with the adjustments of annual numbers as well as current stub and prior stub number. And accordingly, my LTM financials are now adjusted or clean. Also friends, you can see impact of these exceptional items on the reported number. For example, my reported LTM EBIT was 7535, whereas the clean EBIT is 9689. So it is substantially impacted. Likewise, my reported net income was 4547. This is what company reported in the income statement. But if you clean the impact of all the exception items, actually it is 8194. It is almost double the reported one. So friends, you can see in this video that how we can make adjustment of exceptional items in the reported numbers. And to source exceptional items, we can refer MD&A section. In case we find disclosure about this in the MD&A section, good. Otherwise, we can look into 8K release of the company, and sometime we find this reconciliation of GAAP versus non-GAAP number in the 8K, where we can easily find list of exceptional item which is affecting my reported numbers. Okay friends, that's it for this video. And in the next video, we'll do adjustments for the other companies as well, other comparable companies of Dr. Pepper. Thank you.